Silver industrial demand is at the highest level ever recorded in human history. Let me say that again. The highest level ever recorded. In human history, solar panel manufacturers are consuming silver at a pace that was considered impossible 5 years ago. Electric vehicle production is absorbing silver in quantities that no analyst predicted. Semiconductor fabrication, the backbone of every AI data center being built right now, requires silver at every stage of production. And yet, the silver price is not reacting. Record industrial demand, flat price. Today, we look at the data behind this disconnect. The same way we explained the COMEX vault disconnect in our last video. With numbers, with logic, without drama. This is your silver industrial demand complete breakdown. Why demand is exploding, why the price is not reacting yet, and exactly what happens when it finally does. My name is Stack AG. We invest with logic, not hype. Let us get into it. Let us start with the actual numbers, because this is where Stack AG separates from every other channel covering silver. The Silver Institute, the industry's own research organization, publishes annual demand data for every category of silver consumption globally. Their most recent data shows industrial silver demand has hit record levels for 3 consecutive years. Not 1 year, 3 consecutive years of records. The total industrial silver demand number is now above 600 million ounces annually. To put that in context, total global silver mine supply is approximately 820 million ounces per year. Industrial demand alone is consuming approximately 73% of everything miners produce globally in a single year. Before investment demand, before jewelry, before photography, before every other use of silver on the planet, industry alone is consuming nearly 3/4 of annual mine supply. And this number is growing, not stabilizing, not plateauing, growing every single year. The Silver Institute project's industrial demand will continue growing by 5 to 7% annually for the next 5 years, driven by 3 specific sectors that we are going to examine in detail right now. Sector 1, solar energy. Every solar panel manufactured today contains silver. Specifically, silver paste is used in the photovoltaic cells that convert sunlight into electricity. There is no substitute for silver in this application that performs at the same efficiency level. Every attempt to reduce silver content in solar panels has hit a technical wall. The physics of photovoltaic conversion requires silver conductivity. Global solar panel installation targets for 2025 and 2026 are staggering. China alone is committed to solar installation targets that would require more silver than the entire global investment silver market currently consumes. India has announced similar targets. Europe's renewable energy transition requires massive solar expansion. The United States Inflation Reduction Act has committed hundreds of billions to renewable energy infrastructure. Every single one of those government commitments, backed by law, backed by funding, backed by political will, translates directly into silver demand. Not eventually. Now, the silver for panels being installed this year was ordered months ago. The silver for panels being installed next year is being ordered right now. Solar silver demand has grown from approximately 50 million ounces annually 5 years ago to over 200 million ounces today. That is a 400% increase in 5 years. And every projection shows it continuing to accelerate. Sector 2, electric vehicles. Every electric vehicle contains significantly more silver than a traditional internal combustion engine vehicle. Silver is used in the battery management system, in the charging infrastructure, in the electrical contacts throughout the vehicle, in the sensors, in the displays. The average EV contains approximately 2 to 3 ounces of silver. A traditional car contains less than 1 ounce. As the global vehicle fleet transitions from combustion to electric, silver demand from automotive sector grows proportionally. Global EV sales have been growing at 20 to 30% annually. Governments across Europe, Asia, and North America have set mandatory phase-out dates for combustion engine vehicles. Those mandates are not suggestions. They are legal requirements backed by regulatory frameworks that auto manufacturers must comply with. Every combustion engine vehicle that is replaced by an EV over the next decade represents additional silver demand. Multiplied across hundreds of millions of vehicles globally, the automotive silver demand story alone would be enough to create significant supply pressure. Sector 3, semiconductors and AI infrastructure. Every semiconductor requires silver in its manufacturing process. Silver is used in bonding wires, in conductive pastes, in electrical contacts throughout the chip manufacturing process. As AI drives an unprecedented global investment in data center construction, the semiconductor demand that powers those data centers drives silver consumption at a scale that was not modeled in any demand forecast written before 2023. The AI infrastructure build-out is not slowing. Every major technology company globally is accelerating their AI investment. Every dollar of AI investment eventually translates into semiconductor demand. Every semiconductor manufactured consumes silver. 3 sectors, all growing simultaneously, all requiring silver, all backed by government mandates, corporate investment commitments, and technological necessity that does not respond to silver price levels. Now, the central question of today's video. If industrial silver demand is at record levels and growing, why is the silver price not reacting? This is the same disconnect we identified with COMEX vault drainage in our last video. And the answer comes from the same place, the paper market. The silver price is not set by industrial buyers purchasing physical silver for their factories. Industrial buyers operate through long-term supply contracts with miners and dealers. They do not buy silver on COMEX. They do not set the spot price. They purchase through private contracts at prices negotiated months or years in advance. The silver spot price, the number you see on your screen, is set by futures traders on COMEX. Paper traders trading paper contracts, most of whom never take physical delivery of a single ounce of silver. These paper traders respond to macroeconomic signals, dollar strength interest rate expectations, equity market risk sentiment, Federal Reserve language. They are not watching Silver Institute demand reports. They are not tracking solar panel installation statistics. They are not monitoring EV production numbers. So you have two completely separate pricing ecosystems operating simultaneously. Ecosystem 1, the physical industrial market. Record demand, growing consumption. Long-term supply contracts being signed at levels that reflect genuine scarcity. Physical silver premiums rising in some markets. Delivery times extending. Ecosystem 2, the paper futures market. Dollar movements, rate expectations, speculative positioning, short-term trading by participants who have no connection to the physical supply and demand reality. The paper market sets the price. The physical market absorbs the supply. And when the paper price is below what physical reality demands, the gap builds pressure. Pressure that accumulates until it cannot be contained, and then resolves through price. Here is what history tells us about what happens when paper silver price finally catches up to physical industrial reality. It does not happen gradually. It does not happen smoothly. It happens fast, and it happens violently in percentage terms. In 2010 and 2011, when the last major silver industrial demand surge combined with investment demand, silver went from $18 to $49 in 14 months, a 172% move. In 14 months, the move did not build slowly. Silver consolidated for months while the fundamentals accumulated pressure. Then, triggered by a combination of physical delivery stress and speculative positioning, the price gapped higher rapidly and sustained that move for months. The conditions today are structurally similar to 2010. Industrial demand growing faster than supply. Paper market pricing well below physical reality implied values. Speculative positioning building in the managed money category. COMEX, registered inventory declining. The difference between today and 2010 is that today's industrial demand drivers, solar, EV, AI semiconductors, are backed by government mandates and trillion-dollar corporate investment commitments that did not exist in 2010. The demand floor today is structurally higher and more guaranteed than it was during the last major silver bull run. When the paper price finally catches up to physical industrial reality, the move will likely be faster and larger than most investors currently expect. Here is what smart money is doing while the paper price remains disconnected from industrial reality. They are accumulating physical silver quietly, consistently, before the paper price reflects what the physical market already knows. The CFTC Commitment of Traders report shows managed money, large hedge funds, building net long positions in silver futures consistently over recent weeks. These are not retail investors reacting to headlines. These are sophisticated institutional traders with research departments and data access that retail investors cannot match. They are positioned long before the move because they understand the same industrial demand data we just covered, and they are acting on it, not waiting for the mainstream media to explain it to them. This is not financial advice. Always consult a qualified financial professional before making investment decisions. The practical implication of everything covered today is straightforward. Industrial silver demand is structurally growing. It is backed by government mandates, corporate investment, and technological necessity. It does not reverse because of a bad day in the paper futures market. The paper silver price has not yet reflected this industrial reality. That gap between paper price and physical demand reality is the opportunity and the risk for anyone not positioned before the gap closes. Physical silver allocated in your possession or in a verifiable allocated storage facility. No counterparty risk, no paper claims. The actual metal that industrial buyers are competing to secure through long-term contracts right now. Dollar cost average. Build positions gradually. Do not chase single-day moves. Let the fundamentals do what fundamentals always eventually do. Reflect in price. We do not sell silver. We do not sell anything on this channel. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Block and report immediately. Silver industrial demand is at the highest level ever recorded. The silver price is not reacting yet. That gap between what the physical industrial market knows and what the paper futures market is pricing is the same gap we identified with COMEX vault drainage. The same gap that has appeared before every major silver price move in modern market history. The industrial buyers know what is coming. They are locking in long-term supply contracts right now. Smart money knows what is coming. They are building futures positions right now. The only question is whether you know what is coming. Stack AG is here every single day with the data. Every industrial demand report, every vault number, every COT update, every macro shift. So you always have the information before the mainstream does. Subscribe, hit the bell. Share this with one silver investor who does not understand why the price is not moving despite record industrial demand. I am Stack AG Invest with Logic. Not hype. See you tomorrow.